What is a defensive investor? Today, I will teach you what it is. The defensive investor, also known as the passive investor, prioritizes safety and stability over high returns. You want to prioritize a 50-50 split, right, between stocks and bonds, right? It can be adjusted based on market conditions, but the key is to avoid over-concentration in a single asset class. Bonds and fixed income securities, mainly because bonds provide the stability in the income, balancing the more volatile stock market. Government bonds and high-grade corporate bonds are preferred due to their lower risk. Stock selection for the defensive investor. Large prominent companies. Companies that are often referred to as blue chip stocks, well-established, financially sound corporations that have been operating for many years and have large market cap. What characterizes these? Market leadership, reputation, global reach, and resilience. And focus on conservative finance companies. Companies that maintain a healthy balance sheet with low levels of debt and strong liquidity positions. Key financial metrics are the debt to equity ratio. It measures the company's financial leverage. A lower ratio indicates that the company is not overly reliant on debt to finance its operations. Current ratio. This liquidity ratio measures the company's ability to pay short-term obligations. A ratio above 1 indicates good short-term financial health. Interest coverage ratio. This ratio shows how easily a company can pay interest on outstanding debt. A higher ratio suggests better financial stability, right? You want to focus on a long history of dividend payments. Importance. Consistent dividend payments over a long period signify a company's profitability and commitment to returning value to shareholders. Characteristics. Dividend growth. Companies that not only pay dividends, but also increase them over time are attractive, as this indicates robust earnings growth and management confidence in future cash flow. Companies are not going to pay their shareholders if they can't afford it, realistically, right? There are those outliers. Payout ratio. The percentage of earnings paid to shareholders in dividends. A moderate payout ratio, typically between 30 and 60%, indicates a balance sheet between rewarding shareholders and retaining earnings for growth. Financial stability. This refers to a company's ability to sustain its operations and grow over time without facing financial distress. Earnings stability. Consistent and predictable earnings over the years with low volatility. Stable and growing revenues year over year. Healthy and consistent profit margins, indicating efficient management and strong market position. Their earnings history is something you need to look at. A solid earnings history demonstrates a company's ability to generate profits over time, which is essential for long-term stability and growth. Positive and stable growth in earnings per share, otherwise known as EPS, over the past decade, avoiding companies with significant fluctuations or declines in earnings. Return on equity. A measure of financial performance calculated by dividing net income by shareholders' equity. Higher ROE indicates efficient use of capital. Their dividend record. The dividend record reflects the company's track record of paying dividends to its shareholders. Consistency. Companies that have consistently paid dividends for many years, even during economic downturns. We have some great examples like what happened during COVID and the 2008 crisis, right? You can go all the way back to the early 2000s with the dot-com bubble crash. Numerous companies have been around for that amount of time, and even dating back to the 1900s. The annual dividend payment divided by the stock price. A reasonable yield, typically 2 to 5%, is attractive, but very high yields can be a red flag. Depends on the industry, and it depends on a lot of other factors. Dividend coverage ratio. The ratio of earnings to dividends paid. A higher ratio indicates that the dividends are well covered by earnings, reducing the risk of dividend cuts. Example of stock selection. Let's consider a hypothetical of how a defensive investor might apply this criteria. Company A, large multinational corporation with market cap of $200 billion. It is a leader in the consumer goods industry with a well-known brand. Its debt to equity ratio, 0.5, low leverage. Current ratio, 1.5, good liquidity. Interest coverage ratio, 10. Strong ability to cover interest payments. Dividend history. Has paid dividends for 50 years with a 5% plus annual growth rate. Payout ratio 40% is a very balanced approach. Earnings growth. Consistent 7% annual growth in EPS over the past 10 years. ROE 15%. Efficient use of equity. Company B, a mid-sized technology firm with a market cap about 10 billion, let's say. Debt to equity 1.2, high leverage. Current ratio 0.9, below 1, indicating potential liquidity issues.
They ask you how you are, you just have to say that you're fine when you're not really fine.
Interest cover ratio 3, adequate but lower than company A. Dividend history, has paid dividends for 10 years with variable growth rates. Payout ratio 70%, high, indicating less reinvestment into the company.
Stop it. Get some help.
Earnings growth, volatile earnings with some years of decline. ROE, 8%, lower efficiency. Based on these criteria, the defensive investor would likely favor company A for its stability, consistent dividend payments, conservative financing, and strong earnings history. By following this detailed criteria, the defensive investor can build a robust portfolio that minimizes risk and aims for consistent, moderate return.